Hello and a warm welcome to this quarterly update from SKAGEN Kon-Tiki. Welcome to you, Portfolio Manager Hilde Jensen. Recently, there seem to be signs of a shift in sentiment in the emerging markets. Would you say that this is a new trend?
Well, it's tough to make a prediction in terms of seeing 1 week, which we saw the week leading up to April 2nd, showing very strong inflows to equities dedicated emerging markets funds. And that's of course something we welcome and something we love to see, but it's tough to make a trend out of one data point, as you know. So we'd like to take a step back and see if this is something that will persist. The positive aspect is to look at this and say, well, at least it was 1 week of a break after 22 consecutive weeks of outflows from emerging markets. So that we think is very positive, but whether or not this is a trend remains to be seen.
All right, let's have a look at how the first quarter was for SKAGEN Kon-Tiki.
Yeah, I think the first quarter, what basically colored the markets was news out of Russia in general. And as we've mentioned before, we did expect to see some volatility in the markets, and that did materialize. We saw some bumps in the road, and we expect that to continue. Again, the news are also colored by some of the main events coming out of election markets, such as India, Indonesia, Turkey, Brazil, and others. And so those are obviously markets that we're involved in and very interested in. So in terms of valuations, in terms of emerging markets, we're seeing significant discounts of roughly 30% if you look at the price to earnings and also price to book values of these markets. They're trading at, you have to go back to, I believe, 2005, 2006 to find similar discounts. So we find it very attractive time to find new companies.
All right. Spring is in the air, so to speak.
Spring is in the air.
Yeah. All right, let's have a look at the first quarter results.
So the first quarter, the fund, and these are all net of fees, was down 1.2% vis-a-vis the MSCI Emerging Markets Index of negative 60 basis points, or 0.6%. So in relative terms, we were down 60 basis points, and that includes a fairly strong, we saw a shift in March where both our fund and the markets were up in generally. So we think that's positive.
Markets then. You mentioned Indonesia and India now figuring on pretty much on top.
Yes, India had a very strong month, especially in March, up double digits. There is a general positive sentiment there where we have a candidate, looks to be Modi, that will run away with the presidential election coming up in staggered terms. India is a huge country. There's 800 million plus Indians coming to the tolls. 10% of the population will vote via social media, which is a new sort of an unknown factor in the election. But by and large, India has benefited from Modi's sort of pro-business approach to most things and track record. And I think the general optimism is what we're seeing in Indian markets. So it's a very strong, specifically in March, the market has been very strong. In terms of other outlook, I get a lot of questions on emerging markets vis-a-vis developed markets. We saw phenomenal bull markets in developed markets last year. And the question often comes up in terms of how we look at emerging markets as an alternative to developed markets this year and the coming years. Well, we are, as you know, fundamental investors. We look at company specifics. We try not to time markets or predict markets. We find one glaring example of why there was a big diversion in performance between developed markets and emerging markets last year is the fact that the emerging markets didn't benefit from the multiple expansions. That means that investors still demanded quite higher returns in emerging markets equities than they did in developed markets because their perceived risk was higher in emerging markets.
And what about Africa? Any investments there?
Yes, we are. Africa is very interesting to us and continues to be. We have investments in South Africa, among others, in Nigeria, in Ghana, Egypt, and we also have exposure through companies that are not necessarily listed in those countries, but have significant assets and operations in Africa as a general. I think there's two main things to sort of take away from Africa, and one is the increased urbanization that is taking place at a fairly rapid pace, where you find economies in transition from a traditional agricultural sense going into more urban modernization. And the second facet of that is that you find young people that are now highly educated compared to only not even a generation ago. And with the population growth in some of these countries at a rapid pace, you find an interesting shift in the population itself, and that also gives rise to opportunities in technology, for instance, of companies that are able to leapfrog in terms of technology where consumers are skipping over the PC facet and moving straight to mobile phones. So very interesting continent.
Great. All right, just a quick comment on Ukraine, Russia at the bottom of the list.
Sure, and as I mentioned previously, Russia and Ukraine is at the top of the news list, and we get updates every single day. We are invested in Russia, and we have companies with exposure to both Russia and Ukraine. So we follow the situation very, very closely, and we are now currently looking at opportunities. So, for instance, as I'll get to in a little bit, we added on to our position in Moscow Stock Exchange. That's being one of the examples of a company that we think longer term is very well positioned to take advantage of economic developments in Russia.
Okay, let's move on. Main contributors.
So in terms of last quarter, I think what I'll do is, and all this information, by the way, you can find in the status report as well. I'll focus on the two biggest ones on either side. In terms of the largest detractor, to start with the bad news, Sistema, of course, being a Russian company, was pulled down by the volatility in the Russian markets. But the company is very interesting. It consists of, it's a holding company with investment assets that are doing extremely well and have core fundamentals that are very, very strong. They're also in a position now, we think, to announce a major dividend increase in the next few weeks, which we are, as shareholders, of course, looking forward to. We don't think this is priced into the current stock price, and we see there being substantial upside in these shares, the way they're trading now. Hyundai, on the other hand, I hate to sound like a broken record. I know it's a dear contributor to our portfolio, but it remains one of our highest conviction ideas in the portfolio. Hyundai is entering into a major product cycle with the latest launch of the model Sonata, and also now with the anticipated launch in the US in the second quarter of 2014 of Genesis. They're also increasing capacity, which is a good thing. That was a concern for a while, and that seems to be taken away. We also find that the way the preference shares are priced is very attractively. We do own the preference shares and not the common. The preference shares are currently trading at roughly 40% discount to the common, which we think is too steep. Maybe there should be some discount in terms of liquidity concerns, but 40% we think is too much. And also in terms of a price-earnings ratio, the shares are very attractively priced at 3.4 times this year's earnings.
Great. And the changes in the portfolio, you've obviously got a few new companies in. Mm-hmm.
Yes, starting with the additions, always fun to talk about the buys. SBI Holdings is a Japanese online brokerage firm. And it's interesting, that's sort of an example of where we looked at the market structure of Japan as an interesting opportunity. And we took a look at the Nikkei 225 that was up 50% in 2013 in yen terms, which is obviously a great leap forward. forward. However, the index is still trading below 60% of the peak level in 1989. So you can imagine that time frame. Japanese investors have become very disillusioned with the equity markets because there simply haven't been the returns as we've seen. As a result, only 8.5% of Japanese household assets are in equities at the moment, which is extremely low. If you look at the US, that same ratio is 33%. And in the Eurozone, it's roughly around 16%. So there's a lot of room for growth. And we said, well, why is it that the Japanese retail investor does not want to enter, other than obviously having a history now of low returns in the markets? And we found that it's extremely difficult for the average Japanese investor to get any information on the companies. There are roughly 3,700 listed Japanese companies right now in Japan. And if you look at the top 3 brokerage firms, they have only 2 analysts each covering all these companies. How do you get information? It's almost impossible. So we looked at SBI Holdings as somebody who's really, really well positioned to take advantage of this growth that we think will happen as the market gets more developed and information becomes available.
Exciting.
So another Japanese holding of ours is Nippon Yusen. Nippon Yusen is a Japanese shipping and logistics company. They're number 1 in liquid natural gas in terms of fleet capacity, and also number 1 in terms of car transportation, again in terms of fleet capacity. The stock is trading cheaply against global peers, roughly 40% discount, and it's trading at less than book value. So again, an interesting play on growth in Japan. I often get asked, so why Japan? Is Japan truly a emerging market? And our answer is usually looking at the growth prospects in terms of growth estimates and earnings capacity over the next few years. Japan's estimates are around roughly 15%, vis-a-vis other emerging markets at 12%. So we would argue that there is plenty of growth to come by in Japan. Great. UPL, finally, very quickly, it's an Indian agricultural company. UPL is an interesting story because it is a company that's about to transition from being a local player in India to potentially taking the big leap into the global market. The shares are now trading at 8 times forward earnings, which we think is very cheap for a company that's been growing its earnings roughly at 17% a year over the last 8 years. They also have an 18% return on capital, which we find very impressive. And the shares are again trading at a steep discount to global peers of roughly 50%. So lots of upside there, we think.
Let's have a brief look at the flip side of this coin.
Sure. The sell side, Abengoa is the Spanish engineering services company. Abengoa had a phenomenal run the first quarter this year and started approaching our target price. The shares were up roughly 60%, almost 60% at the time, year to date, at the time that we sold out of the position. HSBC was a situation where we found there were more opportunities in other financials, so we sold out of that position. And Royal Caribbean also had a strong first quarter and started approaching our target price, so we sold some of that as well.
Very well. Well, Hyundai on top again.
Yes, Hyundai on top. We talked about that. And again, these are preference shares that we hold both in Hyundai and in Samsung. Which combined, as you can see, make up roughly 17% in terms of the weight in the portfolio. So a dominant weight. These are high conviction ideas. And we also, just looking at our portfolio at the top 35 positions, which currently make up about 72% of the portfolio, are trading at a discount in terms of the emerging market index. Our portfolio is priced at 8 times price to earnings, vis-a-vis 11.5 times for the index, and price to book of 1.1 versus 1.5. So we still think that it is taking the weighted positions of our portfolio, it looks like an attractively priced book.
Great. Do we have anything else?
No, I think
No, we
that's
don't.
it
That's
for
it.
information.
All right. Thank you very much, Hilda.
Thank you.
Great. Before we say goodbye, I would just like to remind you that we are finalizing our brand new market report, and it will be available online shortly. That's it from us. Thank you very much for watching.